Welcome back, session 21, 3-week anniversary. Hope you're having a great day. We'll get right into it. Session 21, make stocks fun. We'll talk today about mutual funds versus stock investing. I started my journey through work on my 401k thanks to a coworker that shared his great success with me. I was like everybody else until that point where I just threw away my statements, not thinking twice about it, until he showed me 30 to 40% returns. And basically, I had to go to my HR and get a key and get access so I could select other funds. And what they don't tell you is that the administrator gets kickbacks for the standard fund. Sometimes that happens. I don't know the percentage of or what have you. I just know that's true of the industry. You do get kickbacks, just like a financial advisor gets kickbacks on recommending some stocks. So you definitely do have to be careful. There's some minefields that I like you to be aware of, but the gold is at the end of the rainbow, and I'm here on this journey to help guide you through the mistakes that I made, so you don't have to make them, and also things like the traps of the industry, so you can avoid them altogether. But mutual fund, I would definitely recommend you pay attention to 401k, set goals. Goals always helps. If you can't hit a target that you don't have, so so I definitely recommend setting a goal, whether it be 10% return, 15% return, or what have you. Have in mind what you do on a daily basis, and then set up your budget, and then setting up 401k is tax deferred, so it's always a wise move. And then you get kickbacks from your boss, sometimes a generous match, so there's free money that you might just not be taking advantage of. But yeah, 401k, talk to administrator, find out what funds they offer, go through the 10-year returns. You always want to go as far out as you can. That gives you the most data to see how the fund performs. Well, other than that, I start with mutual funds. There's nothing wrong with it. The benefits are they're more predictable, less risk. When there's a downturn, it takes longer for them to rebound, and therefore, stocks offer more potential, but they're more volatile as well. But the rebound rate is very fast. So, like for instance, I've been watching, the market has been going down today. We were at 377, now we're at 375, and the stocks, because of that, took a hit. Like I said, the stocks will follow the market 90% of the time. So, like, if the market keeps crashing, obviously, it's very hard to make money on the stock market. That being said, it's just pays to have a plan in place and just follow it as best as you can. Don't get distracted of your goals. Like, obviously, seeing Harley down, it's painful to look at, but then I knew long term that I'll be all right. So it's not that bad. It's no big deal. We just keep going forward. I had a lot of investments that just start out kind of like in the red, and then they rebound. A lot of mine that I brought to your attention a few videos ago with my returns, it wasn't just a straight arrow up. There were some slopes going down, and that I had to grin and bear it for a while until we got on the sunnier side of life. And that's just the investing world in a nutshell. So if you're new to investing, which should you start out with? I would definitely recommend starting out with your 401k. You already have that you're already accessible to it through your work. So definitely check out the mutual funds being offered through that. Other than that, you definitely could start out with the index fund, such as the DIA, which measures the Dow Jones index. It's always a wise idea. You get less risk and you get familiar with the market and know the downturns and the slopes without feeling too much of the pain. You can still, go down and be in a negative. On a mutual fund as well, you can, like I said, the rebound rate is greater. It takes longer for it to rebound. So, you know, when the funds are down, you tend to stay down longer. What allocation percentages should I use? You can use basically what your risk is dependent on your budget. So if you're tight, meaning you're living to paycheck, then it really doesn't matter too much. I mean, you shouldn't, risk what you need ever, because stocks, for whatever reason, can crash and maybe not rebound for 2 to 3 years. That's why, stocks are typically, they say, a 10-year investment. I totally agree with that. So meaning that if you need the money to buy groceries the next month, then it's not smart doing stocks at all, mutual fund or stocks. But if you have everything figured out, your finances look good, and you want to do a budget, maybe have $500 in excess to your bills or what have you, then definitely you could just figure, maybe if you're starting out, $300 into a mutual fund, $200 in stocks, something like that, until you get a grasp on what you're doing and reassess your goals as you go forward. Again, I'd strongly recommend 401k, because you great training wheels. That's how I started, and it makes a huge difference if you understand what the market does, and then to add in more allocation as the market goes down, and just to practice those principles, getting strong through your work 401k is a very, very smart idea. And that's how I started myself. Is this dependent on age? No, it's more dependent on risk again, like how well you budget your money. Do you have, like as you get older, obviously health becomes more of an issue, and do you have enough saved to cover medical expenses? If you're in the insurance industry and you have really good medical insurance and that's not a concern, then obviously those type of people have more to risk. And that's what it comes down to at the end of the day. I don't really believe in allocation percentages in that regard. It all comes down to risk, and how comfortable you are in the market. If you're not comfortable with stock at all, and when the stock goes down and you can't stomach it, and you know that about yourself, then the market's just not for you. To try a mutual fund, and that goes down and you can't stomach that either, then you at least tried, but you at least learned that about yourself, that mutual funds isn't for you. It's no sense, going through the motions of something that doesn't agree with you. You always want to be aligned to who you are and what type of person you are. And that's true of what companies you select. If you're high on water companies for one reason or another, then stay with the water company. If you're high on footwear and you believe that's the way to go, then pick the best foot company that you want. It's all about you and what your heart desires, because no matter what you choose, I can almost assure you one thing, that the stock or the market or what have you will crash. And it's how you deal with that crash that makes you as an investor. I hope this helps you out. This was just a quick little tutorial session, and we'll do these daily. And tomorrow I'd like to get back into FinViz and see what opportunities await us. Now the market's down, there's going to be more out there for us. So have a great day. Hope you enjoyed this video. Goodbye.